When it comes to investing in stocks, understanding stock valuation is crucial for success. And there's no better person to learn from than the legendary investor Warren Buffett. His approach to stock valuation has made him one of the most successful investors of all time. And in this video, we'll explore the key components of Buffett's formula for success, unraveling the secrets behind this stock valuation strategy. So whether you're a seasoned investor or just starting out, get ready to uncover the fascinating world of stock valuation through the lenses of Warren Buffett. First of all, Warren Buffett believes that intrinsic value is the real worth of a company based on its future cash flows. According to Buffett, calculating intrinsic value is essential for investors because it helps determine if a stock is undervalued, potential bargain, or overvalued possible risk. Investors can make informed decisions about buying or selling stocks by estimating the intrinsic value. For Buffett, intrinsic value is the key to unlocking smart investment opportunities and avoiding potential pitfalls. Now, before we proceed, we would like to welcome you to Capitalista. Kindly take a moment to click on the like and subscribe buttons down below. Now, let's continue. Now, let's explore Warren Buffett's preferred method for calculating intrinsic value, the discounted cash flow model. It's like his secret sauce for unraveling a company's worth. The DCF model works on a simple principle. A company's value is the sum of its future cash flows, but with a twist. Those cash flows are discounted, meaning their value is adjusted to reflect the time value of money. And by discounting the cash flows, we're factoring in the idea that money has the power to grow or lose value over time. So the DCF model let us peek into a company's future, estimating its cash flows and determining its present value. It's like putting on a financial lens that helps us see the true worth of a business. With the DCF model, Buffett goes beyond just the surface of a company's earnings and digs deeper into its potential for generating cash in the years to come. Moreover, the DCF model has two key components essential to understanding intrinsic value: estimating cash flows and selecting the right discount rate. Firstly, estimating cash flows involves projecting a company's future earnings. These projections take into account various factors like growth potential and stability. It's like analyzing a company's track record and its industry trends to make educated guesses about its future performance. Next, selecting the appropriate discount rate is crucial. The discount rate represents the investor's expected rate of return. A higher discount rate means higher expectations for returns, while a lower rate indicates a more conservative outlook. Choosing the right discount rate is significant because it affects the present value of future cash flows, and by selecting a discount rate that aligns with their desired returns, investors can make better informed decisions about the worth of a company. Another important aspect, according to Warren Buffett, is analyzing a company's historical performance to project future cash flows accurately. It's like looking back at a company's past to gain insights into its future potential. And by examining how a company has performed over time, we can make more informed predictions about its future earnings. Buffett employs a two-stage model to understand a company's growth trajectory. The first stage is the growth stage, where we assume that the company will continue performing as it has in the past. This stage helps us estimate the cash flows for a defined period, typically around 10 years. The second stage is the terminal growth rate stage, where we recognize that no business can grow indefinitely. It's like acknowledging that there's a limit to a company's growth potential. Buffett suggests using a conservative terminal growth rate, often based on the long-term average inflation rate. This ensures that our projections align with realistic expectations. Moreover, the need for predictability and consistency in a company's cash flows is crucial for accurate projections, and by analyzing a company's past performance, we can identify patterns and trends that provide insight into its future potential. A company with consistent and predictable cash flows is more likely to continue its growth trajectory, making it easier to project its future earnings. Furthermore, selecting the discount rate is an essential step in determining a stock's intrinsic value. There are various approaches to determine the discount rate, and one common method is using the long-term average return of the stock market. However, Warren Buffett has his own preference when it comes to the discount rate. He often seeks a 15% rate of return as a requirement for most investments. Buffett's philosophy involves aiming for substantial returns and carefully assessing the risk involved. Maintaining a consistent discount rate is crucial in Buffett's approach, regardless of perceived risk. Buffett believes adjusting the discount rate based on perceived risk can be misleading. Instead, he focuses on adjusting his requirement for a margin of safety. It's like emphasizing the need for a wide gap between the estimated intrinsic value and the stock's market price. And by maintaining a consistent discount rate, Buffett ensures that his investment decisions are based on a clear and objective framework. This approach helps him make rational decisions and identify potential investment opportunities that align with his long-term goals. Now, the concept of margin of safety plays a crucial role in Warren Buffett's investment strategy. It's like having a cushion of protection against potential risks. The margin of safety is the gap between the intrinsic value of a stock and its market price. Buffett emphasizes the importance of a wide margin of safety to reduce risk and increase potential returns. It's like buying something for less than what it's truly worth, creating a buffer against unexpected events. Benjamin Graham, a renowned investor and Buffett's mentor, recommended a 35% margin of safety for value investors. It's like adding an extra layer of protection to their investments. By buying stocks at a significant discount to their intrinsic value investors increase their chances of earning satisfactory returns even if their estimates are slightly off. While the DCF model is a valuable tool, it's important to acknowledge its limitations. The DCF model works best for companies with predictable cash flows. It may not be suitable for businesses with unpredictable cash flows or abnormal growth patterns. It's a tool with the right conditions to be most effective. Beyond intrinsic value, investors should consider other factors like industry trends and competitive advantages. These additional factors provide valuable insights that complement the DCF model's calculations. So, it's time to apply these principles in your investment strategy. And by understanding stock valuation and using tools like the DCF model, you can make informed decisions and potentially uncover hidden investment opportunities. Remember, a wide margin of safety and consideration of other factors are key. But it doesn't stop there. Successful stock valuation requires continuous learning and research. The more you understand about businesses, industries, and market trends, the better equipped you'll be to navigate the ever-changing landscape of investments. So, do you think you're ready to dive into the world of stock valuation and take your investment strategy to the next level? Let us know in the comment section down below. That's it for this video. Don't forget to express your gratitude by clicking on the thumbs up button, following Capitalista, and enabling notifications to stay updated and won't miss any of our future uploads. See you next time and stay safe.